Good day everyone, especially to you Dr. Riaki here. I'm Hanna Perocho from BSHM3A. So in this video, I'm going to discuss about the chapter 14 that tackles about the insurance law. So according to Estelito Madrid Jr., the CEO of ProLife UK Philippines, there are products that satisfy the protection and investment needs of the market. So let's go for the learning objectives. Enumerate items that can be insured by a tourism establishment. Identify the rationale behind the concept of insurance. Explain the different kinds of insurance and also to identify the advantages and disadvantages of having insurance. So for the topic outline are shown on the screen. So let's go to the introduction. So insurance plays a vital role in the tourism industry where businesses often face various risks and make significant investment. For example, employers may provide group insurance as part of their employee benefits, ensuring protection and support in times of need. Establishments such as hotels, restaurants, and other tourism-related businesses that rely on physical infrastructure may choose to invest in property insurance to guard damages against damages from fire, earthquakes, and other natural disasters. Additionally, companies involved in transporting goods by sea often consider marine insurance to safeguard their cargo. This type of insurance offers a layer of financial security essential for sustainable operations. Insurance contracts in the Philippines are primarily governed by the Insurance Code or the PD 612, known as the PD 1460, and in cases where the code is insufficient, the provisions of the Civil Code of the Philippines apply. So let's go first to the definition and concept of insurance under Philippine law. So according to Section 2 of the Insurance Code PD 1460, a contract of insurance is an agreement where one party or the insurer for a fee called a premium promises to compensate or protect another party or the insured from possible loss, damage, or liability that may arise due to an uncertain or unexpected event like an accident, fire, illness, or death. So for the essential elements of an insurance contract, so for an insurance contract to be valid, it must have these five key components, and these are the insurable interest, existence of risk, assumption of risk by the insurer, risk distribution, and also the payment of premium. So the insurable interests these are the insured must have a legal or financial interest in the thing or person being insured, and also the existence of risk where there must be a chance that a loss could occur. And third one is the assumption of risk by the insurer where the insurance company agrees to take on the risk, and the fourth one, the risk distribution, where losses are shared among many policy holders, spreading out the financial burden. And lastly, the payment of premium, where the insured must pay a fee in exchange for protection. So here are the characteristics of an insurance contract. So the first one is the aleatory, contract of indemnity, onerous, bilateral, and also the formal. So aleatory is it depends on uncertain events. Like for example, is that you only claim fire insurance if a fire happens. And the second characteristic is the contract of indemnity. So this is where it aims to restore you financially, not give you profit, but this applies mostly to property insurance. And the third one is the onerous, where the insured must give something of value or the premium in exchange for coverage. And the fourth one is the bilateral, where both parties have duties, like the insurer provides coverage and the insured pays the premium. And the fifth one is the formal, where a written policy must be issued and the premium must be paid for the contract to be valid. So let's go to the parties involved in an insurance contract. The first one is the insurer, second one is the insured, and the third one is the beneficiary. So this insurer is the insurance company or the provider, and the insured is the individual or business that holds the policy and has an insurable interest, and the third one is the beneficiary, where the person who will receive the insurance benefit when the insured event occurs. So here are also the types of insurance contracts: the life insurance, fire insurance, marine insurance, and also the personal accident insurance. So life insurance protects against the financial impact of death, while fire insurance covers loss or damage due to fire and relatable risk. And the third one is the marine insurance, where it protects goods transported by sea from marine related risk. And the fourth one is the personal accident insurance, where it pays for injuries, disability, or death caused by accidental events. So for the insurance as a contract of adhesion, so insurance contracts are contracts of adhesion, meaning that only the insurance company prepares the policy terms and the insured simply accepts them by signing. So because of this, if there are unclear or ambiguous terms, the law requires that they be interpreted in favor of the insured. So here are the insurable interests. So according to section 10, every person has an insurable interest in the life and health. So of any person on whom he depends wholly or in part for education or support, or in whom he has pecuniary interest. So this means that you can insure someone if you rely on them financially or have money related interest in their life or well-being. So the next one is that of any person under a legal obligation to him for the payment of money or respecting property or services, of which death or illnesses might delay or prevent the performance. So this means that you can insure someone who owes you money or services, because if they die or get sick, you could suffer a financial loss. So also according to this section 13, every interest in property, whether real like lands or buildings, or personal like items like cars and jewelry, or any connection to it or responsibility for it, is an insurable interest. So as long as the loss or damage to it would cause the insured person direct financial harm. And also according to this section 14, insurable interest in property may be an existing interest where an actual ownership or possession, in Kuwait, interest founded on an existing interest where a developing or expected future right based on something you really own. And the third one is an expectancy coupled with an existing interest where a future benefit you expect to get, like an inheritance, as long as it's connected to something you already have a right to. And for the section 15, a carrier or depository has an insurable interest in the items they are transporting or holding. So this means that, but only up to the amount they are liable for if those items are damaged or lost. So for the discussion of these sections, that it means that an insurable interest is a legal or financial relationship with a person or property that justifies buying insurance on it. Like you must have something to lose if that person dies or that property is damaged. So you must have this interest, like for property insurance, both when you get insurance and when the loss happens, and for health insurance, only when the policy takes effect, where even if the relationship ends later. So let's go to the insurable interest in group insurance. So anyone with legal or business connection to another person may get insurance on that person's life, such as an employer insuring employees or vice versa. So group insurance is a single contract that covers many individuals under one plan, usually employees of a company. It offers affordable protection for employees and their families, promotes loyalty, and also helps in employee retention. So to claim group insurance benefits, these are the way to claim group insurance benefits. So the employee must be actively working and also must have completed a certain time of employment. So if they resign or are terminated, the insurance stops, but they usually have 1 month to cover it into an individual policy. So let's go to the insurable interest in property. So in property insurance, it is essential that insurable interest must exist at 2 points in time: when the insurance contract is made, the time the policy starts, and when the loss happens, like during a fire, thief, or other damage. So this means that you must still have a financial or legal connection to the property at both times to make a valid claim. So in so in marine insurance, the owner while in the marine insurance, the owner of a ship always has the insurable interest in it, even if someone else has rented or chartered the ship has agreed to pay for it in case of loss. However, in this case, the insurance company will only cover the portion of the loss that the ship owner cannot recover from the charterer to prevent double compensation. So the amount of or extent of insurable interest is measured by how much financial loss the insured would suffer if the property is lost or damaged. So you can only be compensated for the actual financial harm you experience. So if a property insurance policy gives the insured more money than the actual loss, it becomes illegal or contrary to law because insurance is meant to indemnify or make whole, not to give profit. So let's go to the next one, the beneficiaries. So according to Section 18, no insurance contract or policy on property can be enforced unless the person benefiting from it has an insurable interest in the property. So this means that the beneficiary must have a legal or financial connections to the property insured, someone who would suffer a loss if the property is damaged or destroyed. Well, according to the Section 19, for property insurance, the insurable interest must exist when the policy starts and also when the loss occurs. So this means that you must still have a financial interest in the property at the time it's damaged to claim compensation. While for the life or health insurance, the insurable interest must exist only when the policy takes effect. So even if the relationship ends or the person insuring no longer benefits from that person's life, the contract is still valid. So let's go to the fire, marine, and third-party liability insurance. So for the marine insurance, according to Section 99, marine insurance includes an insurance against loss of or damage to vessels, crafts, aircrafts, vehicles, goods, freight, cargoes, merchandise, effects, disbursement, profits, money, securities, chosen in action, evidence of death, valuable papers, bottomry, and respondentia, interest, and all other kinds of property and interest therein in respect to appertaining to or in connection with any or and all risk or perils of navigation, transit, or transportation, or while being assembled, packed, crated, hauled, compressed, or similarly prepared for shipment, or while awaiting shipment, or during any delays, storage, transshipment, or shipment incident thereto, including war risk, marine builders risk, and all personal property floaters risk. So this means that marine insurance covers a wide variety of movable properties that may be lost or damaged due to the risk involved in transporting them, including while they are being prepared, stored, or transferred. It also includes war-related risk and floating property risk. And the second one is where person or property. This is connection still under Section 99, where a person or property in connection with or appertaining to a inland marine, transit, or transportation insurance, including liability for loss or damage arising out of or in connection with construction, repair, operation, maintenance, or use of subject matter of such insurance, but not including life insurance or surety bonds, nor insurance against loss by reason of bodily injury to any person arising out of the ownership, maintenance, or use of automobiles. So this refers to the coverage for people and properties involved in marine-related activities, like building or operating vessels, but excludes life insurance, surety bonds, and auto-related injuries. And the next one is the precious stones, jewels, jewelry, precious metals, whether in the course of transportation or otherwise. So this means that high value items like gems or jewelry are also covered by marine insurance, even if not currently being transported. Also, bridges, tunnels, and other instrumentalities of transportation and communication, excluding buildings, their furniture and furnishing, fixed contents and supplies held in storage, piers, wharves, and other aids to navigation and transportation, including dry docks and marine railways, dams, and appurtenant facilities for the control of waterways. So this means that this includes infrastructure essential for marine and land transport, like bridges and docks, but does not cover buildings or their fixed contents. So, marine protection and indemnity insurance, meaning insurance against legal liability of the insured for loss, damage, or expense incident to ownership, operation, charting, or any craft or instrumentality in use in ocean or inland waterways, including liability of the insured for personal injury, illnesses, or death or loss or damage to the property of another person. So this is a liability insurance for vessels owners or operators covering injuries, death, or property damage connected to the use of a ship or other maritime craft. So let's go to the next one, the fire insurance, where according to section 167, as used in this code, the term fire insurance shall include insurance against loss by lightning, windstorm, tornado, or earthquake, and other allied risks when such risks are mentioned in fire insurance policies or under separate policies. So this means that fire insurance not only cover losses due to fire but may also include damages caused by lightning storms or earthquakes as long as these are specifically stated in the insurance policy or covered under separate agreements. So here are the compulsory motor vehicle liability insurance. So according to the section 373, for purpose of this chapter, motor vehicle is any vehicle as defined in section 3 paragraph A of Republic Act numbered 4136, otherwise known as the Land Transportation and Traffic Code as amended by the PD 1455. So this refers to all types of vehicles like cars, motorcycles, trucks, buses, etc. used on public roads. And also for the B, passenger is any fare-paying person. The second one is the passenger, where is an any fare-paying person being transported and conveyed in and by a motor vehicle for transportation of passenger for compensation, including persons expressly authorized by law, the vehicle operator or his agents to ride without fare. So a passenger is someone who pays to ride a public transport vehicle or who is legally allowed to ride for free, such as an official or authorized guest. And the third one is the third party. It is any person other than a passenger as defined in this section and shall also include a member of the household or a member of the family within the second degree of consanguinity or affinity of a motor vehicle owner or land transportation operator as likewise defined herein, or his employee in respect to death or bodily injury arising out of and in the course of employment. So this means that third parties are people who are not passengers, such as pedestrians or other motorists who may be injured in a motor vehicle accident. It also includes close relatives or employees of the vehicle owner if they are injured while doing work-related tasks. So for the next one is the land transportation operator. This means that the owner or owners of the motor vehicles for transportation of passengers for compensation, including school buses. So this refers to the people or companies who run public transportation services using vehicles like jeepneys, buses, or school services vans. So the next one is the insurance policy or policy, refers to a contract of insurance against passenger and third-party liability for death and bodily injuries arising from motor vehicle accidents. So this policy guarantees financial protection to passengers and also for the third parties in case of injury or death caused by motor vehicle accidents. So also according to the section 374, it shall be unlawful for any land transportation operator or owner to operate the same in the public highways unless there is enforced in relation thereto a policy of insurance or guarantee in cash or surety bond issued in accordance with the provisions of this chapter to indemnify the death and bodily injury and or damage to property of a third party or passenger as the case may be arising from the use thereof. So in this section, this means that the public vehicles cannot legally operate on roads unless they have the valid insurance or financial guarantee to pay for injuries or damage caused to passengers or other in an accident. So according also to the section 377, every land transportation operator and every owner of the motor vehicle shall before applying for the registration or renewal of the registration of any motor vehicle as his option either secure an insurance policy or surety bond issued by an insurance company authorized by the commissioner or make cash deposit in such amount as herein required as limit of liability for purposes specified in section 3074. So this means that vehicle owners must show proof of insurance or an equivalent financial guarantee before they can register or renew their registration with the Land Transportation Office or the LTO. So let's go to the war risk insurance. So war risk insurance is an insurance covering damage caused by acts of war. So this type of insurance protects against financial loss resulting from war-related events which are normally excluded from standard insurance policies. So it includes coverage for war, hijacking, and related perils. So aside from war, it also covers situations like airplanes, hijacking, and terrorism-related acts. So insurers have intended to withdraw liability coverage for weapons of mass distribution, a subset of war insurance. So many insurance providers have started to exclude coverage for damages caused by the WMDs due to their catastrophic impact and unpredictability. So WMD includes the radioactive contamination or the explosive devices that disperse radioactive materials, and also the electromagnetic pulse devices were the weapons that can disable or destroy electronic devices and infrastructure. And lastly, the chemical or the biological weapons were the weapons that use toxic chemicals or biological agents to cause harm. So limited to a maximum of $950 million for all third-party injury and property damage. So there are a cap of International Air Transport Association or IATA has argued that airlines in countries that do not provide coverage are at a competitive disadvantage. So this means that airlines that must pay for expensive private war risk insurance might struggle to compete with those governments provide support. So under Federal Aviation Administration program, or the insurance coverage for passenger and third-party liabilities for U.S. airlines is approximately $70 passenger compared to almost $3 outside of the U.S. So in the U.S., thanks to the government assistance, airlines pay less than $1 per passenger for this coverage, whereas other countries may pay over 4 times more. So this IATA policy in most jurisdictions, including the European Union, airlines are required by law to have a liability insurance including coverage for WMDs. So aircraft lease agreements also requires coverage of war risk insurance, where when airlines lease planes, the lease contract usually demands that the aircraft be insured for war risk. Since the use of WMDs is directed against states, the ultimate responsibility for security of citizens rests with the states. So the government and the states are expected to protect their people from acts of war or terrorism involving WMDs, as these are political and national security matters. So let's go to the conclusion. So in conclusion, insurance serves as a crucial safety net for the tourism industry, helping businesses manage the financial impact of unexpected events, whether through group insurance for employees or property insurance for establishment or marine insurance for transport operations. So these insurance protective measures ensure stability and resilience. By complying with legal frameworks such as the Insurance Code and the Civil Code of the Philippines, tourism businesses can operate more securely and confidently, fostering a long-term growth and sustainability in an industry exposed to constant risk. So that would be all for the chapter 14 that tackles about the insurance law. Again, I'm Hanna Perocho from Base HM3A. Thank you for listening and goodbye.